Welcome to the Elevate Market Chat with Kyle Ottman and Shane Fleury. In today's episode, we will discuss the latest FOMC meeting, financial markets, and a few financial planning topics submitted from our listeners. If you have anything you would like us to discuss, please submit your questions to info@elevatecapitaladvisors.com, and don't forget to like, subscribe, comment, and share this podcast to help us spread the word. Here we go. Content is for entertainment purposes only and is not investment advice. Please consult with a financial professional before taking any action. All right, so Shane, might as well get right into it. We had the FOMC meeting yesterday, and Jerome Powell got up, gave us some news. What were your takeaways on it? And should we be concerned about the pace of rate hikes, and how is that looking?
Yeah, well, good question, man. Good to chat with you again here today. As far as takeaways, I was a little surprised that uh, the expectations for rate cuts later this year uh, weren't reduced. The last projection from the Federal Reserve Bank was that they would cut interest rates perhaps 3 times in 2024. And as we were going into this meeting, over the past few weeks, many people started to bet and guess that when the meeting was over, the projections would be for maybe only 2 cuts instead of the full 3 cuts this year. So I was a little surprised to find out that the market, or sorry, not the market, but the Federal Reserve Board of Governors, right? All the people who get to put not even all the people who get to put a vote in, all of the members of the Fed, whether they have a vote or not, they sort of put, pencil in where they think interest rates are going to be at certain points in the future. And it's not a plan. It's like a survey, right? Where I send you a survey, you send me a survey, we answer the questions about what we think the winning lottery numbers will be on whatever day, and then we tally them all up at the end and see where it comes out on average. And so that's what they call the dot plot, and the dot plot is still calling for three cuts in the interest rate in 2024. So I think that's the big focus of the market reaction, is that's dovish, and the market's expecting that those rate cuts are going to push stocks even higher. So they're buying stocks in anticipation of that happening. I personally have my doubts. I don't see them cutting rates at all this year. And for listeners out there who don't watch this stuff every day, just as an example, well, Kyle, do you remember how many cuts the market was expecting or pricing in January?
I don't recall that number.
It was 6. They expected the Fed to cut 6 times in 2024. And do you remember when they expected the cuts to start?
I think it was June, wasn't it?
No, it was originally in the March meeting that just ended yesterday. So the market was 100% sure that there would be a rate cut in the March meeting as recently as January, and since then, inflation data has come in higher than expected, and those expectations have been pushed out now to June. I think July is actually the first 100% chance of a cut, according to the futures markets. And so, they were dead wrong then. I think they're dead wrong now. I think the only way that the Fed cuts even a single time this year, certainly before the election in November, I think is if the market is in full-on crash mode and they need to save us from a 25 or 30% drop in the stock market. I think that's the only way we get a cut before the election. Remember, Jerome Powell is a Republican, and cutting rates, heading into the election would stimulate the economy and perhaps give Biden a better chance of getting reelected. So, if you want to play the political game, which I try to stay out of politics because it's just, I don't know, it's not intellectually stimulating to me at all. And I don't care for politicians or politics in general. But if you think that's important, then you would want to know that Jerome Powell is a registered Republican. And for that reason alone, if they don't play, if the Fed is trying to be apolitical, the right thing to do is not cut rates before the election. And with an economy that's growing, um, and inflation that's accelerating, it doesn't make any economic sense to cut rates either. So I don't know. I just kind of think the odds are against any type of cut happening before the election, which of course is in November. And I think there's only one meeting after that, which would mean, maybe one rate cut. So
Yeah.
that's where I come down on it.
And I think that that's pretty in line with my thinking in terms of cuts, but my justification might be a little different. And I think mine is just, well, why did they start raising in the first place? And it was because inflation was high. And what does inflation being high mean? That means everything you buy at the grocery store, stocks, bonds, whatever, assets, just any asset out there has gotten too expensive. And I look around, and right now the CRB index, the Commodity Research Board, that covers that broad basket of all commodities. And it looks like, a very bullish chart. I would buy it. You've got that going on. You've got stocks at new all-time highs. Why would the Fed cut rates and proclaim that, the war against inflation is over?
Yeah. No,
I just
I don't
don't
think
see
they
it.
will.
Yeah.
Nope. Doesn't make
So
any economic sense at all to cut rates here if that's why they started hiking them. I totally agree.
no, and I think, we talk about it oftentimes, but it's always good to be a bit of a contrarian. And right now the market is all in this camp of getting 3 cuts this year and inflation being tamed. And yeah, I just don't see that. So we'll
Uh,
see. I know right.
Inflation, by the way, inflation hasn't been tamed at all. I mean, it's, still running well above the 2% target by almost any measure. And if you look at, I can't remember the word for this, but if you look at a chart of CPI currently, over the past, I guess since 2019, a chart of the consumer price index, rate of change, annual rate of change in prices. If you look at that from 2019, every quarter since 2019 till now, it is pretty much a perfect mirror of from 1971, for I guess 5 years till 1976. And what happened right about now, back then, right? If you're looking at these charts compared to each other and overlaid on each other on the same time frame, is that the Fed declared victory a little too early. They said, "Oh, well, inflation has come down from its peak. It's almost back to our target. Let's start cutting rates because there was stagflation going on and oil embargoes and all type." This is a little bit before my time, so I'm going off the history books here. Um, but they declared victory a little bit too early, and what happened was that inflation began to resurge and spiked to an even higher level, up to over 14% than it was at before that. At the prior peak, it was only at 12%. And so the current chart looks eerily similar to the chart back then. And I think Powell is a student of that 70s style inflation. He's cited many, many times. I can't remember, maybe it's Arthur Burns. I can't remember the guy's name from back then before Volcker. I think it was Arthur Burns. And he cited many times, that he is a student of that and that he doesn't want to declare victory too early. So I do think for a lot of reasons, interest rates will remain higher for longer. That we won't get as many cuts as soon as the market seems to think, or even that the Fed seems to think. Um, the question is, how does the stock market react to that?
Right. And right now, so I will say, when I am looking at the market, and I think that's a good transition point, um, the market breadth is looking great. I just went in today, and I used to always pull up a chart and I had all the different sectors, and it would show what percentage of each sector was over the 5-day moving average, 20, 50, 100. And you go in there, and every single sector is now picking up. And what is a positive is that industrials right now are leading. So you're seeing a bit of rotation. You're not just seeing tech and the Mag 7. So the Mag 7 now, I was just looking through those charts, and it looks more like the Mag 5, Apple and Tesla right now. do not look so good. Tesla's been in a downtrend for a while, and then Apple looks like it's trying to hang on, but it also kind of looks like it's starting to roll over. And if it doesn't hold 170, looks like we might have some more downside. But you're seeing some cracks here. But yeah, the breadth is just something else right now.
Well, I have a slightly different take. I mean, if anybody read my commentary from a couple of weeks ago, you will see a whole bunch of different charts in there that outline how is the S&P 500 doing compared to how the S&P 500 equal weight is doing. And as of the end of February, it was pretty clear that the the S&P 500 was way ahead of the equal weight index. Equal weight was only up 3%. The S&P 500 was up 6.84%, so more than double what the market was doing. And beyond that, the Magnificent Seven was up 14.04%, so more than double what the S&P 500 was up. And within the Mag 7, there's really only 4 stocks, not even 5, that are doing well. And if you just look at those 4 stocks, which the market, the financial media has started calling the famous 4, they're up 31.14% as of the end of February. And so that's, again, more than double the Magnificent Seven. So it's kind of crazy how concentrated the returns are. And even if I go measure it right now, which I did just before this call, the equal weight S&P 500 is still lagging behind all of these other indexes. Although, if you measure from February 13th to yesterday, the equal weight has outperformed the S&P 500 benchmark since the middle of February. So definitely there is a little bit of pickup coming in the broad market. So a bit of a broadening rally, if you want to call it that, at least over the past month.
Right. So one positive, but it is something else when you look at the S&P 500 right now is up about 10% year to date. And February, that is a seasonally weak month. We never saw any kind of a material pullback there. And it just keeps going along. It's hard to believe that this is a healthy uptrend, but you certainly don't want to be picking tops here.
Oh,
I
I
don't.
will not believe that this is a healthy uptrend. This is silly. It reminds me of 2021 we were just talking about before we started recording. But I mean, 2021 is, if you remember, was the dawn of the meme stock mania, where GameStop and AMC were the 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 stocks with the highest return of the year, and both of them are, at least fundamentally speaking, like insolvent, bankrupt companies, right? But the stocks went up the most because why not? They were giving away money and people were putting it into the stock market. So the government continues to give away money. You mentioned that earlier. That wasn't on our list of things to talk about, but we talked about it in our Slack, our company Slack, earlier this week, that the government continues to stimulate the economy despite the fact that the Fed is trying to tighten policy. So you've got opposing forces. The Fed's trying to slow things down, and then you get this guy in the White House, and even the people in Congress, all of them are to blame. But I heard actually this morning that that Biden was forgiving another $6 billion of student loan debt somehow today, despite the fact that the Supreme Court ruled his plan for student loan forgiveness as unconstitutional. They're still finding all types of backwards ways to have me and you pay for people's education who don't want to pay
Yep,
for it on their own, which is just beyond frustrating and stupid.
it is. And it offsets the fight against inflation. Kind of moderates what rate hikes do. So, but interesting market we're in right now. I mean, it just keeps going up. Inflation does not seem to really be slowing down. And I think that's probably a good summary. And maybe we can turn it over maybe to a financial planning topic. What do you say?
Wait, first, before we go too far, just in the meme stock arena, the place that started it all, Reddit, right? The front page of the internet. If you know what Reddit is, Reddit started trading stock today. Today's its IPO day, so you can now go trade stock in Reddit. RDDT is the symbol. And that is where that just literally started trading within the past 30 minutes, it looks like. So $51 a share. You can buy Reddit, which was responsible and continues to be responsible for, meme stock investing. If you don't know what that is, just type in the Google. But if you have Netflix, you've probably seen some of these TV shows they've even made about it, and movies they've made about it. It's pretty fascinating information. Fascinating information. So check that out if you haven't. But yeah, Reddit IPO day.
Yep.
Oh, and one other thing is I reopened my short in Tesla today. Tesla is my third largest gaining position of the year, and it's down like 30% for the year. So how do you make money on a stock? Not just a little bit of money, but have it be your third best position of the year when it's down 30%? Well, we do that by shorting it.
That you do. You could short it, or there's even some, fancier ways we won't get into on this call, but selling call options,
Yep,
one way to make a little bit of money. So a
that's right.
few things out there. But well, Shane, on the financial planning, you brought this question to me, and I thought this was, pretty interesting. Is that so ministers actually have the option to bypass Social Security. They have to make this decision within the first 2 years of doing so, or working in that profession.
Right.
And so you and I started kind of just talking is, well, is it good to bypass it? And what are your options? I know you have a pretty strong background in annuities. Maybe we can hit on that, but just big picture, what does that entail? And I know just first off, so self-employment tax that goes towards Social Security is 12.4%. So that's what we're talking about here is take your gross income, 12.4% of that. Do you want that going towards the government to help you with Social Security, or do you want to do something on your own? Maybe we can just start it there. Kind of, what were your thought initially on this?
Well, I don't like participating in Ponzi schemes, so if it were me, I would probably not participate just as a matter of practice. If I could opt out of Social Security and not put any money into that program, which is insolvent, bankrupt, you name it. I mean, it is literally a Ponzi scheme where they take money from current, people who are currently putting money in and give it to people who put money in before. It's literally the definition of a Ponzi scheme, and there is not enough money there for everybody to get back what they have put in. It's just simply not possible. So I would not participate. In fact, I try. I don't know. Hopefully, I'm not getting myself in any trouble here, but I try very hard to pay as little money into the Social Security program as possible by paying myself as a business owner as little as I can kind of get away with as a reasonable salary, right? And taking the rest of my income in the form of profit distributions, which are taxed, which avoid sort of the payroll tax. So there's some rules, as you're earning money and working and you own a business. I can't just pay myself $1 and pay no Social Security tax on that. By the way, I wonder how some CEOs of some companies get away with that. They have like this ceremonial salary of $1, and then they get paid the rest of their income in like stock options and stuff. It always sounds good, but I'm like, how do you get away with that? Because you're supposed to be paying a certain, a reasonable wage so that you pay into these systems. Because of course, they don't work if people aren't paying into them. So
Right.
anyway, that's a conversation for another time. Maybe we'll write down that question and talk about it in an upcoming show. But yeah, personally, for me, I would definitely opt out of Social Security completely if I could, because having a bankrupt government responsible for my retirement income just sounds like a really terrible idea.
Mhm. And I think there is an added benefit beyond just that cash flow stream in the future. So, one is disability. If you become disabled during your working career, you can get compensated from that. But the big question I had is just like, I ran the numbers here. Let's just say you made 50,000 a year and you're going to work for 30 years, your salary will go up with inflation. And instead of taking that 12.4% and giving it to the government, what if you took that and you were able to invest that and earn, let's say, 8%? So I think that's kind of an average equity return. That might even be just a little bit on the low side. But if you did that after 30 years, Shane, what number do you think you'd have sitting in an account?
Ooh. Um, it's gonna take me too long to come up with a reasonable guess, so I'd say, I don't know, 100 grand.
So actually 30 years, every year you put 12.4% in, and every year your salary goes up by, 2%. So with
Yep.
inflation, acting on that assumption, you'd have $920,000.
Man, compounding, it's just so wonderful.
So there's certainly a case to be made where, particularly with a younger person, if you're evaluating this decision, is if you start putting it away and you think you might be able to invest better than the government, it compounding for 30 years, I mean, you can build yourself a really nice nest egg, and it it's your capital to do with as you please instead of, if you wait for the social security check, not only might it never come if you have to wait that long, because we all know social security is certainly running on a thin budget at this point, but you also have the ability to decide what you want to do with that money. And the social security you get, if you earned enough money through other buckets that's taxable, you'll actually get taxed on your social security. So I think there's certainly a case to be made here where opting out of social security could be beneficial.
I think yeah, I think it's a no-brainer. What's the key though? The absolute key, because here's where most people get screwed up, is they opt out and they get their paycheck and they're like, "Man, this is cool." And they spend all the money and then they run up a balance on their credit card. So the 12.4% just gets eaten alive every year from now until 50 years from now. And
Mhm.
then instead of $900,000 sitting in the bank and invested in the markets and generating, a nice retirement for them, they've got 50 grand in debt and they just have to work until they die. So that's the key, right? The absolute key is that you have to have the discipline to take the money, put it away, invest it in something, um, ideally into something good, or whatever the rate of returns were that you used. Um, can't remember what you said, but
Yeah, it's
you know,
8%. So that's a
yeah. So
generally good, stock portfolio.
that's
So
that's more than the average return of the S&P 500 since the turn of the century and millennium. Because it's only S&P 500's only earned on average 7% since the year 2000. So I mean, 8%'s a pretty good return. But I think you could do even better than that if you pay a little bit of attention to what you own and why you own it, and hold on for the long run, and sell things when you realize you're wrong. I think through active management, you can do a lot better than that over a long period of time. And it
mhm,
doesn't mean you have to sit and day trade either. That just means paying attention to what's going on and what you own, and knowing what it is rather than just blindly and passively owning the whole market.
right. And the other thing too, I just want to drop in there is that for the understanding of how Social Security works, how do they even figure out how much you would ever get? It's based on your 10 highest earning years. So throughout your career, your 10 highest years. Now, I don't know the exact formula, but those are the salary numbers they're going to look at. So there's a lot more nuance to that, and we can get into a whole other discussion. But generally speaking, that's the numbers they're taking and then figuring out what that benefit would be. So yeah, definitely a case to be made. And I like being free from the government. So, like you, I think we would find ourselves in similar positions there.
Maybe we'll come back to the Social Security thing too, because I think there's a little bit more to chat about as far as how to extract money from that program. We talked about whether or not to get money into it, but what happens when you get to the point where it's time to start taking money out? In fact, let's just hit that real quick, Kyle. When you
Sounds
start,
good.
when you look at Social Security and you're 62 or you're at your early retirement age, what are the factors that people should consider when they decide, should I claim my Social Security now, or should I wait until the latest age when I'm 70? How do you think about that?
So, few things. One is, are you currently working? If you are and you start drawing on Social Security, like I mentioned earlier, you might not actually be taxed on that Social Security. So you could watch that income kind of amount to nothing. Um, Another option is, spousal benefit. If you want to claim, maybe you're retired and your spouse is working, you can claim on that. But one concept I want to hit home that I often look at is it's in my mind, it's just an annuity based on how long you're expected to live. So if you get that money earlier and you invest it better than the government, you might actually turn that into a decent, portfolio or nice little nest egg for yourself. Whereas if you wait, all they're really doing is spreading it over a shorter number of years and it's increased by inflation and maybe a little more up to that point. So that's kind of how I look at it. What are your considerations?
So the biggest thing I think to know is that, and I'm gonna use a word here. I'll try and unpack it, but Social Security is a program as far as when the money starts coming out. It's actuarially equivalent. And what that really means is that if you live until your projected life expectancy based on current mortality tables, actually not even current mortality tables, but older, these mortality tables go back a ways. I don't think they've updated them in a while, which is why the program is broke. Um, but if you live to your life expectancy exactly to the day, to the millisecond, right, and you die and you don't cash any checks after that, it makes absolutely no difference whether you take it early or take it late. Like you said, if you take it early, you'll get a little bit less money spread over a lot more years. And if you take it late, you'll get a lot more money spread over fewer years. But between the time you start and the time you die, you will get the exact same amount of money. That's how it works.
Right.
So if you knew that you were going to die at exactly what the government is projecting you to die at, as far as your age, um, then you just have to decide. It's a simple equation. Like, what do you prefer? It's really just a preference thing. And yeah, certainly if you have more money earlier that you can just then invest and get some growth on for that many years, you might do better. However, the wrench gets thrown in where you're very healthy, you take really good care of yourself, um, you you eat well, you exercise, all that kind of stuff. Well, you're very likely to live past the average life expectancy because you got to remember the average life expectancy includes everybody. It's an average of everybody. That includes people who are, sticking needles in their arm and eating out of trash cans and fighting in wars. I mean, you name it, all these dangerous things that tend to end people's lives early, um, they're included in that average, right? So a lot of people are not gonna. Well, half of the people aren't going to live that long, and the other half are going to live a lot longer. So if you're in the half of people who are going to live longer than your life expectancy, this probably the smartest thing to do is wait until your latest retirement age, because the government's going to give you what amounts to an 8% increase in that annual income every year that you wait, and you will get that higher dollar amount for as long as you're alive, which could be until you're 100 or more.
Hmm.
If on the other hand you're very unhealthy, you might have, had a diagnosis of some type of medical issue, you don't have a lot of confidence that you're going to be in the group of people that lives past life expectancy, then I think it makes a lot more sense to take Social Security as soon as possible. Um, so that's how I think about it. And I think those are absolutely the most relevant items. But you can make it a little bit more complicated, like you said, with well, if I took it early just so that I could invest more money in the stock market and the stock market goes up more than the 8% guaranteed increase that, I'm going to get from the government anyway, which of course they can't afford. So, if the whole program runs out of money and they stop sending checks, then definitely you want to get it out as soon as possible. But that changes the calculus a little bit if you're just planning on not using it to live to maintain your living expenses, but you're actually going to invest the money and try and get a higher than 8% return. But a guaranteed 8% return is pretty hard to beat. Like we just talked about, the S&P 500 hasn't even averaged 8% a year since 2000. So
Right.
I don't know. It's kind of a hard one to pass up if you're 65.
Yeah. Well, we've got three questions here, but let's go ahead and hit the first one.
Well, I think we got more than three. I think we might only get to three, but I know we got more than three questions from people. And if you're listening, please send us your questions. I mean, if we said anything so far that wasn't clear, or you think might be wrong, or you just have a follow up question on, We'd love to have your questions. You can send them to info@elevatecapitaladvisors.com, or if you have my email or Kyle's email address, just shoot us a note, give us a call, whatever works for you. We'd love to have more questions to answer on future shows.
Yep. So, yeah, the first one is NVIDIA. That's just been the strong, leader of the pack this year and last year. And we would say, well, now it's overpriced. And the question is, and
It
well,
was overpriced last year.
yeah, it was overpriced last year. So, how do you think about that? Why were we not in it 6 months ago? And what do you do now?
Yeah, well, to be clear, the question did come from an existing client, and he very specifically asked, yeah, Nvidia is overpriced, but the question is why were we not in it 6 months ago? So to be clear, we are not giving any financial advice, and I can't really give out portfolio construction advice on this call. But what I will say, and it's certainly not advertising for our portfolios either. But my answer is that we were in it 6 months ago. We just don't own it directly. We actually purchased the semiconductor ETF right around that time, maybe a little bit prior to 6 months ago at this point. Um, and we chose to gain our exposure to NVIDIA through the ETF, which gives us exposure to a lot of other semiconductor stocks as well, which some of which are more overpriced and some of which are less overpriced. And so we just chose to take our exposure that way. NVIDIA is 22% maybe um, of the semiconductor ETF. So we have a fair amount of exposure through that. And then we also went ahead and took on some exposure to one of NVIDIA's competitors, AMD, Advanced Micro Devices, I think is the full name of the company. And the reason we chose AMD to own outright, in addition to the ETF, which holds it as well, is simply that it was less overvalued at, I think, only 8 times earnings instead of, or sorry, 8 times sales instead of 36 times sales. And of course, both of these stocks have just gone, higher and higher and become more and more and more overpriced since then, despite rising revenue and, pretty much everything going perfectly for them. So there's nothing wrong with, as we talked about in our last podcast. If you haven't listened to it, go check that out. But there's nothing wrong with owning stuff that's overpriced. I mean, it's overpriced because it won't stop going up. That's what makes it overpriced. And so as a momentum investor, that's what you want to own. You just have to have an exit strategy.
Yep.
And so, my answer to the question of why didn't we own NVIDIA 6 months ago is that we did. And I will also just go ahead and say that not buying NVIDIA, not 6 months ago, but more like, I'm going to pull up a chart real quick here. When we should have bought NVIDIA
I think it was
was,
last year in February, if I'm right. There was a nice, for those technicians out there, nice reverse head and shoulders pattern that it broke
yeah,
out of.
there was, my spot to own NVIDIA was January, end of January, basically, of 2023. And I got an alert to buy it when it crossed back above its 200-day moving average. And I chose not to buy it. I said, well, hey, it's showing a lot of momentum right now. That momentum should cool off. It'll pull back to its 200-day moving average, and that's where I'm gonna pounce. I'm gonna buy it. And I waited and waited and waited and waited, and earnings came out in February of that year, and it gapped up and got further away from the 200-day and was overvalued, more than 10 times sales at that point. And I just said, okay, well, it'll come back to the 200-day moving average. And I swear to you, since then, it was, what did I say it was? It was 175 bucks a share, basically, you know, and the 200-day moving average was right around 165. And so I thought we'd get to buy it right around the 200-day moving average. Since then, it has gotten never within, like, $100 of its 200-day moving average, and the stock has gone all the way up to almost $1,000. And it's one of the biggest lessons of my entire career. Just, that was a huge mistake not to buy NVIDIA when it came back above its 200-day moving average, because we did own it before. and we got stopped out.
Mhm.
And the whole plan was to buy it back. I preach this all the time. It's like, hey, look, if you want to own something, you can't be afraid to buy it back when it rallies back, even if you got to pay a slightly higher price than where you sold it. Who cares? I mean, if it's going from 100 to 1,000, who cares that you're paying a little bit more than where you sold it last? It doesn't matter. You got to make that money. And so, in all fairness to the question, it's not about that we didn't own it 6 months ago. It's that we didn't own it, you know, right when it crossed that 200-day moving average back at the beginning of 2023. Because since then, even to today, after the slight pullback from highs, it's up 415%, and that's a huge missed opportunity. So
Yep.
I own that one and learned a lot from it.
And then on that, so what is the secret formula for catching a trend near
Well,
or in the beginning?
you're the chief market technician, Kyle. I'm gonna let you answer that. What is your secret for catching? Like, how do you know when you're at the beginning of a momentum burst, if you want to call it that?
The big thing is you want to see a nice base build. So what that means is a lot of times you'll just have a stock that's kind of boring for a while and it just has a lot of trading action all happen within a range. And then what really makes it a standout is relative strength. So that's what I look for a lot of times. What that means is simply if the market is weak or pulling back and that stock is just holding in there or maybe even going up, it is telling me that there's a lot of buying activity. There are people that they don't really care what the overall market is doing. They're supporting that name. And you can bet that when the market starts getting positive or just kind of move sideways, that stock can really take off. So that's what I'm looking for. What I'm not doing is looking for headlines. If I'm reading something off Motley Fool or anything like that, that's just old news. You can get lucky and maybe something is on there, but I just want to look at charts and I want to see something building a base, starting to show that relative strength, watching volume come in. That's telling me that thing could start to go.
Got it. So when you say building a base, you just mean a long period of trading between, some price level. So say a stock is for the past 6 months, it's trading between $190. It's within a $10 range or a 10% range of the high. And it's just staying in that range and bouncing all around in that range, but not really going anywhere outside of that range for how long? For 6 months or a year, or is there a time frame that you're looking for it to kind of consolidate like that for?
I would say the longer the time period that it consolidates, the more power it can have in that upward move.
Hmm.
What you
Or
don't
or a
necessarily,
downward move if it decides to
yeah,
break down, right?
yeah. And what you don't necessarily want is something where it just came off of just getting pummeled for the last year or two. And now it's got this little base that built for let's call it a month or two. That's not something you want to get into. It's going to take a lot of time for everyone that bought at that higher price to kind of get their bearings straight, get out of positions they want to exit before that's going to take off. So that's where yeah, you're looking for something where it could have had an uptrend and then just move sideways for a long period of time. Or maybe it's just never really taken off. And now it's starting to try to get out of this base.
So from there out of the base, how do you know that it is actually in an uptrend and it's not just a fake pop to ultimately come back into the range or even reverse lower?
A lot of times you're just looking for that confirming volume. So you want to see buying interest really push it out.
Hmm.
And nothing's foolproof, so you will have ones break out. I think a lot of times you hear the statistic at 30% is what you're looking for. So 30% of the time you find something like this, it works.
Yeah.
So you definitely need to have a sound risk management plan.
Yeah, you know what I think, man, is like, um, well, I think there's two things I think about it. No, number one is that the secret to catching them, the secret form. Like, here's the question: what is the secret formula to catching a trend near the beginning? I think the secret formula is to realize that you're going to be wrong 70% of the time when you try to catch it near the beginning. And so you don't know which ones of the trades that you try to catch early, you'd never know at that time which ones are going to be the 70% that fail or the 30% that work. You don't know going into it, because if you did, you would just skip the 70% that fail and put all your money in the other 30% that work, right? So the only way that you know is in hindsight. And so the way that you do it is by eliminating the ones that are going to fail quickly and early, right? So, you buy a breakout as close as you can to the point where you can arguably say, hey, it's breaking out and there's extra volume here. And then you are absolutely relentless about following a stop. If it breaks back down into the range, you got to be out. If it breaks back lower than where you entered, you got to be out. And so by eliminating the ones that are going to fail on you, you're going to be left with only the ones that are going to work. And so I think the secret formula is really to, like you said, just have a really sound risk management strategy that eliminates all the failures quickly, and then you're left with only the successes. So I think that's really what it boils down to me. And then the other, well, does that make sense?
No, that makes total sense. Excuse me.
And then the other thing is one measure that I've come to like is just using a trend. So, using say and using a 50-day moving average as the trend. So if this is getting a little technical, so I apologize for the jargon, but if you take the average closing price of a stock over the past 50 days and just plot that on a chart and then connect it, with a line, just connect the dot style. If that is moving down or sideways, then there's no momentum. The momentum is downward momentum, not upward momentum, right? So, but if you plot that, we call it the 50-day moving average. If you see that for 20 straight days, it has gone up. It's not flat anymore, it's not down anymore, but 20 consecutive days, call it 21 consecutive days, number of average trading days in a month, basically. If it increases, even if it's only by a penny a day, right? But it goes up every single day for 20 days, you are probably in the early stages of an uptrend. There's no guarantee. What I said a minute ago still applies, right? Like if you buy that, it's not like, hey, every single time you see a stock with a 50-day moving average that's gone up for 20 days is automatically going to go up 1,000%. Unfortunately, this game is not that easy. If it were, you and I would not be recording a podcast right now.
Right.
I would be on a beach somewhere, in my yacht, whatever. So it's not that easy. It's really difficult to do this, right? If it were easy, everybody would do it and everybody would be a bazillionaire. So it's really difficult what you're trying to do when you're trying to play these momentum bursts. So, but that's just one factor, right? Where I think that you can use that as a litmus test to say, okay, the 50-day moving average on NVDA has gone up every single day for the past 20 days. If you had done that in early 2023, you would have ended up being right on NVIDIA. Granted, you would have tried it on 9 other stocks, 7 of which would have failed, right? But you would be left with NVIDIA up 400%. So if you only lost, 10% each, and that's a lot. If you lost 10% each on the other 7, but made 400% on NVIDIA alone, you're up. You made money, right? You lost 70%, made 400%. You're still up more than 300%, right? So that's the name of the game, is keeping the losers small and letting the winners run big time.
That's it. And then, so you kind of touched on it, but when does momentum occur? And it's when you have that moving average and people finally start to get convinced that this thing is going to go higher and they missed that nice buyable base. And then they
Right.
start tripping over each other trying to get in. And that's when you see those rallies that sometimes they go parabolic, but they can have a lot of steam behind them because everyone's trying to get in those shorts that were short and they knew it was going down. Every time it just keeps inching up, they're finally giving up and they have to liquidate, which means they have to buy shares to get out.
Yeah.
And that's where you get that momentum.
Right. Yeah. So thanks, Eric, for the 3 questions. Again, the 3 questions were NVIDIA is overpriced, but the question is, why didn't we own it 6 months ago? And second question was, what is the secret formula to catching a trend near the beginning? And the third question, when does the momentum occur? So thanks, Eric, for listening and for shooting us your questions. If you got any more, send them our way.
Absolutely. So Shane, I think that kind of wraps it up. Anything else you'd like to hit on before we part ways?
Yeah, I mean, only that we've got a few more questions that we would love to get to, but we also want to keep these things to to a reasonable amount of time. We know you're busy and your time is important, and so help us out. Send us some questions. It helps us improve our content and talk about things that are relevant to you, our dear listeners. So thank you for tuning in, and look forward to catching up in about a month.